Hi, I'm Chip Stites, and this is The Laughing Retirement. Now, today we're going to talk about a subject which, in some ways, is actually almost laughable. Now, what subject is that? Well, last time we covered beta, and beta is how we measure risk. And it's interesting. I got an email today from one of the class members who said that in the CAPM, or the capital asset pricing model, there was a blurb about how beta was actually systematic risk. And after saying it for so many years, it's nice to hear somebody else who thinks beta is a way to measure risk. And I think it is. Because if you've got a low beta, then you've got low price movement. If you've got a high beta, you've got high price movement, which means in a drop, you're going to lose more than most if you have high price movement. In low price movement, in a drop, you're going to lose less than most people. And so beta is pretty important, but that's not what we're covering today. Today, we're going to take a look at yield. Now, I'm going to share a screen here, and yield is one of the 4 reasons that I buy a stock. It's called getting paid for the risk you take. Remember back in 1996, I talked to a guy whose father had saved $5 million on a salary of about $5,700 a year. And it was almost unbelievable to me. But what he had done was what I'm doing today, with some minor changes. And one of those things that he did was he insisted that every time you buy a stock, the stock paid him for the risk he took. So that's what we're going to talk about today, which is yield. So why is yield so important? Well, it is a payment for the risk you're taking. It pays you back for your willingness to invest in something. The board of directors of the company that pays you a dividend is more aligned with what you need than the board of directors who doesn't. That's pretty simple. If they're willing to send their company money to you, then they want you to invest. The company that doesn't is interested in growth, and maybe it'll grow and maybe it won't. In a significant market drop, dividends don't go down like the market does. You see, even in a huge market drop, the average dividend will drop about 10%. So if you have a 5.5% dividend, in a huge market drop, you're going to wind up with a 4.95% dividend. That's not too bad. Now, according to Mark Lichtenfeld in the book, Get Rich with Dividends, which is right here, Ned Davis research says that reinvested dividends are responsible for 95% of the growth of the S&P 500. Now, you don't hear that very often. What do you have to do to reinvest a dividend? Well, you push a button that says reinvest, and then the dividends get reinvested. That's what I do. Many dividends increase in size every year. We call them dividend growth stocks. And we're going to talk about that next. But today, we're just talking about dividends. So during a market drop, a reinvested dividend gives you a built-in gain. Now, why is that? Well, let's say your stock price drops 15% from $10 to $8.50, and your dividend was 55 cents a share. You own 100 shares. So you collect $55. But now, instead of being $10 a share, the price of the stock is $8.50 a share. So your $55 buys you 6.47 shares, where as a $10 a share, you would have gotten 5.5 shares. So you actually gained a share and a half that's going to pay you an additional 1.5 times 5%. And the market will eventually go back up again. So you have a gain just because the market dropped and you reinvested. It's like the perfect answer. Buy when the stock is low. You just did it. But you didn't have to do anything to do that. So when the price rises again, your dividend increases. You have new shares. you have a new capital gain, and you have more dividend. Dividend investing or value investing works over time and allows the investor to keep up with inflation. Now, we'll cover inflation in the next part of this series, and it's one of our 4 pillars. But suffice it to say that getting paid for the risk you take is extremely important, and that market drops actually favor you in the long run. Everybody's afraid of market drops. I welcome them. Market goes down, I'm going to make more money. It's a simple deal. Now, types of dividend-paying stocks, there's a lot of them. You can find them in every sector of the S&P 500, but mostly they're in consumer staples, utilities, and healthcare. You'll also find them in real estate. Now, what are the types of stocks or ETFs that we look for that give a high or a good, if you will, dividend? Royalty trusts, master limited partnerships, closed-end funds, REITs or real estate investment trusts, preferred stocks, business development corporations or BDCs, and SPACs or special purpose acquisition companies. And many of those have different tax implications. One of those where you're likely not to pay any tax on it at all. I know that sounds crazy, but it's true. One of the reasons that we advise people to get out of IRAs is because you don't get the tax advantages of the stocks. And you continually have to take out more and more and more. Not if your money isn't an IRA, you can actually lower your tax payments. So now, the cost of investing with an advisor who uses high expense funds and annuities. It's relatively easy to keep up with taxes and inflation using our formula. It's impossible to replace the cost of an FA and high tax investments now, or high cost investments. The average advisor costs about 1%. High cost investments cost another 1%, and that's 2%. But 2% doesn't sound like much. But it's not just me who says that. There's a guy who's died a few years ago. He was well thought of in the industry. His name was John Bogle. He's the founder of Vanguard Funds. And in his testimony before Congress in September of 2014, he said, I estimate the cost of investing in most 401ks can cost an investor up to 63% of what they might otherwise save. 63%. Let's put it simply. In a 401k with an investor, with an FA, a financial advisor, and high-cost funds, you could either save $200,000 or you could save $400,000. You could either save $450,000 or $900,000. Now, which would you rather have? That difference is 2%. Now, if you don't believe me, and I don't expect you to, I want you, and I'll show you where to write me at the end of this. I'll show you where to write me. I want you to send me an email that says, Chip, I don't believe you. I want you to show me your spreadsheet. That 2%. I have proven it's not 63%. What I have shown is about 50. In other words, if you could have saved $450,000 without that 2%, one to the FA and one to a high cost of investments, you'd have saved $900,000. Huge difference in your life. So if you're interested in that, send me an email. I'll be happy to show you, happy to talk to you. Now, yield to cost, here's another one. So we talk about yield, and yield is a function of the rate that they're paying. And let's just say 5% for argument's sake. On a $10 stock, that would be 50 cents. And let's say that my dividend is 50 cents and I have 100 shares of this stock at $10. That's $1,000. So they're paying me $50 and I reinvest my shares. Now, over 5 years, I reinvest my shares, and I now have 125 shares at $12 a share, which is $1,500. The dividend is 5%, but now, because of my reinvestment, I'm earning $75 instead of my original $50. Now, if I take $75 and I divide it by the $1,000 that I originally put into the investment, my yield to cost is 7.5%. I have talked to people whose yield to cost is 30%. They're earning 30% a year on money that they invested years ago. What are they doing for it? Nothing. They're just sitting there watching it. Now, what do you do to earn this? Well, I went out and actually watched this flotilla of people. It's an annual event. It's an annual event here in Rieti. It's a float down the river. It's one of the things I did while I was earning my money. I went to the Vatican with my sister. We went out to dinner. We had a party with friends. We did all kinds of things while we were earning money. In other words, to earn these dividends, once you've learned to pick a good stock, you don't have to do anything. You just sit there and watch the money come in. Now, if you have questions about yield, what is it? How does it work? Why does my yield go up and down? Well, your yield does go up and down periodically, because if the price goes up, and I'll use my 5% example. I have a $10 stock, and I have a 5% yield. So I'm getting 50 cents a share on my $10 stock, and it goes up. Price goes up 20%. Well, now my yield is 4%. So you say, well, I lost yield. No, you didn't, because you didn't buy additional shares. The price just went up. So the company is still paying you. They're still paying you the same rate. You're still getting the same amount of money. But the yield, which is the rate that they're paying you divided by the price of the stock, your yield goes down. You're still earning the same dollars, but your yield goes down. You see, once you set this up, you don't have to do a lot to earn the money and to make yourself wealthier. Now, what can you do now? Well, you can send me an email. It's right there. It's to thelaughingretirement.com, info@thelaughingretirement. Say, Chip, I'd like to talk to you about your expense spreadsheet. I'd like you to prove that to me. I'll be happy to. You can go to Calendly and go to this Calendly and say, Chip, I would like a free 20-minute talk. You can watch our other videos. You can watch our masterclass. Or you can join the group and take the course, start collecting your monthly dividends. I'll be happy to talk to you about any of it. That's why we're here. It's relatively simple. Now, next week, we're going to take a look at dividend growth stocks. What's that mean? Well, we'll talk about it next week. And we're also going to give you a simple formula for success. Okay? I hope you'll join us. I hope you'll send me an email or book a 20-minute chat. This is Chip Stites. And this is The Laughing Retirement. Enjoy.